Let's focus on the market fundamentals then. And while the breadth continues to weaken today, about 116 standing to the declines to just about 18 odd to the upside. And yeah, OMC is reversing the trend. That really seems to be the standout factor. But let's focus on other things. And Asian markets clearly have come in the grip of risk aversion as data has been showing flows turning negative. So before we discuss the phenomena with an emerging market CIO, Rahul Chadha of Mirae Asset, let's take it across to Ajay Sharma, my colleague from the research desk, to talk about the picture the data is indicating. Ajay, what's your observation?
Good morning, Aisha. Yes, in the last couple of hours, this particular issue of flows has taken center stage, at least in in markets here in India. When we speak to a lot of asset allocators, they are taking a look at this data point, saying that up till now local liquidity has been supporting the market, but if the outflows from emerging markets accelerate, look at that data point. On a YTD basis, we are almost $500 million plus negative. On a year till date basis, as well as 12-month basis, we are gone down. Yes, the number is much smaller compared to some of our emerging market peers like Indonesia, Malaysia. But if the trend continues, if the dollar continues its march and emerging markets currencies continue to be under pressure, this is a worry which is really gripping the market right now. And if you look at the total emerging market outflow right now, has come to a number close to a $12 billion figure, which is one of the biggest we've seen in years. And crude oil prices also is a big worry for several emerging markets like India. So worsening macros and increased outflow because of currency coming under pressure is the big issue to talk about. And that's why we scheduled this very interesting chat with the emerging market strategist, somebody who is of Indian origin and now looks at the entire emerging market space in totality, and hence will be able to give us much better perspective.
Oh, absolutely, Ajay. Rahul Chadha, who's the Co-Chief Investment Officer at Mirae Asset Management, joins into the show. Rahul, you've been associated with us almost 9 years out of your 12 years at Mirae Asset Management. So it's been a fairly long association, and we, of course, really appreciate the support that you've extended out and this relationship that we've had over the course of the last 9 years. Thanks very much for being there.
No, thanks for having me.
Let's start straight into the discussion on what's happening with emerging market ETF flows. We were just reading the headlines this morning about nearly $3 billion withdrawn. You know, as an asset manager, and I know that you're more you're looking at things from an active perspective. Even so, do you think that passive products can infuse a kind of volatility that could be a nightmare for active managers such as yourself?
No, clearly, it caused a lot of volatility in the interim, but that's an opportunity for active investors like us who are focused on strong bottom-up stock picking. In last couple of months, we've been going out and talking to a lot of our existing and prospective clients, telling them that, look, there is a huge difference between the perception and reality. And perception is that, look, this is the end of the global economic cycle, whereas the actual reality is that we are somewhere in the middle of the cycle. So people are very worried about the US-China trade wars, the trade rhetoric which is coming. And our view still remains that, look, both the parties, particularly from China's side, they've handled it in a very mature way. And we don't believe that this significantly escalates from here. So we're still constructive on markets. Valuations are in investors' favor. There is an underlying recovery across key emerging markets. We would look to buy the dips here in EMs.
Rahul, hi, morning. Good to have you on the show and celebrate our 9th anniversary with us. But tell me, what's the India call? Would you say that we're at an inflection point? Because pessimism clearly seems to be at an all-time peak. You know, there are all the concerns about the rupee depreciation, crude doing what it's doing, the impact on trade deficit, the government turning populist, it being, a run-up to the election year. And on the flip side, while the index is still just about close to its all-time high, the broader market sell-off has really unnerved investors. But would you say that this is the time when you invest because pessimism is at its peak?
Okay, so a lot of questions in one. Let me try to address them one by one. Again, if you look at the underlying recovery, that's getting stronger. Again, I was in India a couple of weeks back. Across the sectors, when you meet corporates, whether it's rural, semi-urban recovery, again, clearly there's an improvement. Corporate India came out of a strong kind of an a headwind scenario in 2017 where earnings got impacted or revenue momentum got impacted because of demonetization and GST, and that's behind us. As a result of which we are seeing things improve from here on. I think the million-dollar question is what happens to the tax revenue collection of the government, and that's where we are watching the GST revenues very closely. Should market get the comfort that, like it happens in every recovery, the tax revenue buoyancy is here with the improving economic outlook, I think bulk of the fears would be behind us, or bulk of the fears would be mitigated. You'll see the bond yields behave well from there on. You'll see rupee behave well. Again, we talk a lot about rupee, but look, Korean won, which is part of a current account surplus economy, is also depreciated by 5-7% in recent weeks. So the currency depreciation is more of an EM phenomena rather than an India-only phenomena. What one is watching closely in India is, again, the tax revenue buoyancy which takes care of the bond yields. Overall, from a bottom-up level, you're getting good, interesting opportunities in India. Clearly, again, the staples are expensive. So outside that, there are much more interesting sectors to put money to.
You know, that's of course your India view, but I want to understand how your India positioning holds in the larger scheme of things. When you look at the big picture right now with these ensuing trade war tensions between the US and China. First, of course, it fuels a concern of, higher prices, which can, of course, lead to upside risks to inflation and can slow down economies such as the US and China, where, there was much concern riding on the fact, there was much hope riding on the fact that if these two economies started their growth momentum, then that would fire up the growth engines of other economies as well. In lieu of that, do you think that we would see a fair amount of unwinding in the markets as growth estimates get reworked? Is that a fear that you kind of share with your investors and clients? Do you get that sense that we could perhaps be overshooting on being very optimistic about growth revival?
Okay, so I think what you're talking is an extreme doomsday scenario where, again, the trade wars escalate from here, where what we've seen initially is the 50 billion of imposition of tariffs in terms of Chinese exports to US gets kind of further extended to another 150 billion or 200 billion of Chinese export to US. Should that happen, then eventually markets would start faring the worst. But look, if somewhere this kind of gets restricted here, on these limited exports China does to US in terms of getting or attracting tariffs, then I think the impact on the economies would be a lot more limited, because from our perspective, what we are looking at is the underlying recovery. So the underlying recovery in China continues to be strong. And what's happened is China went through a period of deleveraging over the last 6 months. From recent comments you hear from PBOC, they've again started kind of an easing in the domestic economy. What we're seeing in China is a big story of consumption upgrade, availability of retail financing, similar to what we are seeing in India. Close to 65% of the GDP in China today is consumption, and that's growing at 9 to 10%. So there is limited risk of hard landing from China at this point of time. From a US perspective, what we are watching is the investment cycle. So if you look at 2018 YTD, we have got investment spends up about 6 to 7%. Investment cycle was lacking for the last 7 years in US, and as this picks up, obviously it helps the rest of the world. Which is why we are not, it's easy to be bearish because all the newspapers, all the things you read around is bearish. But look, what I'm trying to say here is the bearish sentiment is in price. I mean, you look at factors like a city economics surprise index, so that's kind of at rock bottom. You look at the capitulation which has happened in some markets. It shows the extreme amount of bearishness which is there. Whereas there is an underlying recovery which is happening across markets. And unless something seriously wrong happens, what happens is economies have their own momentum. And right now that virtuous cycle is under play across most markets.
So then, give us your, while you've summed up how you look at the India position in the broader emerging market strategy, how are you looking at opportunities within India? And I would want to start off with your outlook on pharma. Have you started buying into pharma over the last 3 to 6 months in lieu of all the positive news flow that's influencing the sector?
Okay. Now, pharma space looks really interesting. it looks interesting here clearly because you've seen a spate of FDA clearances for these companies. This was something which was holding back approvals in US, while you could see the existing pressure on the portfolio basically which these companies had in the US. So selectively we've been adding to our positions in the pharma sector here. But look, valuations aren't cheap, and that's where it's not been easy to build a large exposure here. So one is looking at select names, and clearly the space looks interesting at this point of time basically.
Curious to know, Rahul, what's the take on Indian banks and not the HDFC banks of the world, but the ongoings with the management shuffle which is happening with ICICI Bank, Axis, largely, the large corporate retail structured banks and PSUs. Do you find value in PSUs, or do you think that's a space best avoided?
Okay, so let's talk about private sector corporate banks, which are easier plays at this point of time. I think the problem in the past was that, look, they not fully recognized the NPAs. Some of these were kind of hidden as restructured assets. B, what happened was the provisioning on the overall kind of an restructured NPA book was only 20%. So that provisioning is now closer to 40-45%, which is a fair haircut they've done. And then to give added comfort to the investors, what we've seen is with these large private sector banks, management changes. I mean, clearly, management changes were much required after banks went through a period of whatever, more than 10% gross NPAs. So with that happening, worst is behind us, and we clearly believe that retail franchise for these banks is doing well. And the positivity is not reflected in the valuation, which is where the risk reward is in favor of investors.
Right. So, so give us your sense. I mean, between the large cap private banks versus the PSU banks versus NBFCs, and also bring in insurance, what would be your pecking order in terms of investment priority?
Actually, you can have more than one over here, because if I look at our India funds, financials will be still about 35% of the portfolio, and we continue to like it. And clearly, again, the consumer banks are kind of in your structural holdings, so you don't touch them. I mean, they keep compounding at 20-25%. Corporate banks, you're looking at them opportunistically, where most of the bad news is in the price. PSU banks, one would be very selected, probably look at SBI, but nothing beyond that, but very selective in the PSU banks, because we believe that, look, structurally, they are on a path to lose market share. They're going to get all the more impacted as digitization becomes all pervasive in banking. So they'll be, again, under pressure. And coming to NBFCs, there are few select NBFCs which are doing good jobs. These would be NBFCs focused on the rural segment of the economy, where still it's tough for banks to make significant inroads. And finally, insurance is a space we like. Look, if you look at the regional benchmarks, the weight for insurance would be 30-40% of that of banks. And with this rising prosperity we're seeing in India, people saving for their kids' education, their own retirement, I think insurance is an underappreciated space, and in due course, we're going to see representation for the insurance sector also increase in benchmark. So that's a space we like quite a bit in India.
Rahul, what's bringing optimism in housing and infrastructure as a segment to you?
See, again, sometimes what you've got to do is weed away from the noise and look at the underlying attractiveness of the asset. Housing in India has never been as affordable as it's today. Unlike markets like Hong Kong, where again house prices were on a tear over the last 5-7 years, we've seen prices go nowhere, and incomes have grown at least 10%. So clearly that.
Oh, we seem to have snapped that line just when we were getting a call in real estate from Rahul as to why, he was just highlighting that just shun away all the noise, and you're seeing that bit of a revival come out in the housing sector, and right now perhaps is the time to really put in money to work when it comes to real estate. And he was also making the point as to how housing is now seeing a bit of a pickup, and that pickup is really showing results. So we will get back to him and get in his detailed view on what he makes of real estate. For the markets though, we're in line with the rest of Asia. We're down about 0.5%, and that's exactly what the STX Nifty as well was indicating. Yes, the breath is pretty bad today, so that's well in favor of the declines. About 100 stocks within the F&O market standing to the red line, to just about 32 thereabouts standing to the advances of 50 odd actually, and 155 to the decliners. It's MRPL which is facing the heat today, down about 4%. BP, HP, IOC, the entire OMC cluster which is feeling the heat right now. But Rahul Chadha is back with us, and Rahul, you were making the point on real estate that, you know, housing pickup is now finally beginning to show results, and this is the time to put your money to work.
No, absolutely. Again, affordability is the best it's been in last 20 years. And what we've seen is post-implementation of RERA, a lot of quality listed developers are gaining market share. RERA works in favor of the property buyers also in terms of timely completeness, completion of the properties. So which is why we are positive on the housing developers, we're positive on some of the entities which kind of cater to the segment. And that also explains our positivity on cement. Cement gets close to 60% of its demand from housing. We've seen uptick in rural housing. We're likely to see uptick in urban housing in next couple of years. And that makes us positive on the space.
Give us a big picture view, because, you know, over the course of the next 5 years, and especially accounting for the political transition that may come by next year, if at all, one is going to look at how the allocation to India would stand from a long-term perspective versus the rest of the region. How do you position India once we are past that hurdle, and how much of that hurdle would be influencing the overall trend on the market?
Okay, so if you look within Asian portfolios, obviously Hong Kong as a key component of portfolio would be accounting for close to 50% of the portfolio. I think where India is gaining share is from markets like Taiwan, etc., where demographics are poor, where consumers are indebted, where tech industry, which was the main kind of industry for Taiwan, is getting eroded in terms of, or seeing its competitiveness erode by the Chinese companies. And I think that's where India kind of comes in with your growth rates of 6 to 7%, nominal GDP doing a 10-11% growth rates, and there are plenty of quality companies. And from our exposure, we continue to like banks in India, some of the infrastructure stories like again cement, select consumer discretionary plays, whether it's a jewelry retailer like Titan or automobiles like Maruti Suzuki. So longer term, we are positive on India. Look, one is mindful of the fact that market may underperform closer to the elections. But we believe that if the fundamental changes which the government's done over the years, which is infrastructure for the semi-urban rural part of the economy, electrification, financial inclusion, work their way, I think India is going to be one of the few economies which is going to grow at least at 5 to 6% for a foreseeable future. The risk remains largely currency, which is where one would like to see more comfort, more work being done on this Make in India campaign, which started with a big bang, but we've not seen meaningful increase in foreign direct investments. As consumption aspirations increase, we've seen imports rise considerably. So I think if you ask me, much more than the political uncertainty, I think the bigger risk for India is what happens to rupee, or if the trade deficit balloons, do we again lose 2-3 years correcting the imbalance and then embark on a growth trajectory?
Is a tactical view, Rahul, over the next 5 years, or do you think it's going to be developed markets or emerging markets which will outperform? Okay,
I think what happens is next 2 years, it's highly likely that EMs kind of do well. And if you're willing to take a 5-year view, we're fairly confident that, look, you may have periods where there may be bouts or there may be quarters where there is extreme risk aversion. DMs may outperform EMs for those small periods of time, but over a medium-term perspective, which is a 5-7 year perspective, we believe that EMs like China and India would continue to outperform developed markets.
That's interesting to hear. And do you think largely the risk of rising cost of capital is a far cry now in terms of the impact it can have on equity markets world over? Right now, you know, we are seeing the first phase of that risk play out, which is essentially equity markets buoyant on account of growth recovery.
Okay, so this is what the market itself is grappling with. Basically, rising cost of capital, withdrawal of some of the QE. At the same time, you have an underlying recovery which is strong. I think what happens is, in due course, you'll have sectors which have become 40, 45 times derate because you have some withdrawal of this liquidity, whereas other sectors where valuations are below mean get an uplift because the recovery is getting a lot more broad-based. So it's going to be a lot more to each of the sectors, nuances, etc. What we look at and what matters, we believe, is the real interest rate. So if you look at US, the real interest rates is still 50 bips. Historically, whenever this real interest rates, you can call it a negative carry, is in excess of 3 or 4%, it's derailed recovery. So we continue to maintain our view that this is a mid-cycle correction rather than a late cycle worry about recession. So markets kind of a sell-off, but then we look at the underlying recovery. We look at where you've got good business models, strong managements, and where valuations are in favor. And I think that's where one would kind of reap the rewards of quality stock picking.
Rahul, great to have you on the show. Thanks very much for being a part of our 9th year anniversary programming. We really appreciate it.
Thanks again for having me.